outcomes, right? In terms of COVID was, there's maybe a week or 2 weeks where it got really serious, but again, it was still over a 2 week period. It wasn't just like one day COVID's not here, next day COVID's here, right? And kind of that type of very sharp market reaction.
Binary. Yeah,
Yeah.
binary.
And I think here that definitely happens on an election. And so, from an asset allocation standpoint, do you basically go into the election almost with like, I'll call it like a Trump presidency plan and a Biden presidency plan, and then depending on who wins the election, the directive can change based on who that presidential candidate ends up being, or do you go into it more with maybe a range, and you say, if it's a landslide, then we're going to be on the most extreme end of this. If it's not, maybe we have kind of a more moderate change to asset allocation. Like, how do you just think about that going into such a binary event like this?
So it's a great question, and our clients have been asking this a lot lately, no surprise. And my answer is we never want to make grand or sweeping portfolio changes around a binary event because it's so easy and the odds are very high that you're going to be on the wrong side of that outcome. And so our best advice is really to maintain a well-diversified portfolio through, around binary events, but take stock of what the exposures are in your portfolio. Be mindful of positioning. And if there's something that you're really concerned about, and I can talk about some of those things, then it may be worth making adjustments, but we're never going to be all one portfolio or all one another, depending on the administration. That is an important component to the path forward for the markets, but it's not the only component. And I would just say, at the end of the day, really, because COVID is still very much alive and well here, it has not faded into the backdrop, even though the data has started to look better over the course of the summer. We're now starting to see a resurgence in Western Europe, and there is the potential for the COVID curves to start hooking higher here in a more sustained way in the US. And so at the end of the day, we actually think that is much more critical to the pace and timing of policy changes coming out of Washington than just the election itself. That is, it's a bit of a mixed blessing. I don't know if that's kind of a crazy thing to say when you're in a pandemic, but it will slow down grand and sweeping policy changes. So if we have a change in control, that new administration and whoever is controlling Congress is still going to have their hands full trying to figure out this COVID story, not likely to start slapping, big tax increases in right out of the gate in the new year. And so we may ultimately get them, right? But it's a little bit of a slower, longer, drawn out process in our view. And so I think that will help to calm equity markets in particular, but just public markets in general, if we were to get a change in control. Some of the things that we're thinking about, though, I can talk through. So the biggie, if Trump were to stay in control and get reelected, is what happens on the trade policy front. If you think back to 2018 and even 2019, every time he put out a tweet talking about trade policy or a change in tariffs or an escalation, whether it be China, Mexico, our trading partners in Europe, and so on, the market freaked out. And yes, that is a technical term. I mean, the market just hated the stance that he was taking around trade policy. For better or worse, that has faded largely into the backdrop. So we got a handshake agreement, if you will, pre-COVID at the end of 2019. That was a very welcome, sigh of relief that effectively was now in the rearview mirror and the market could chart a path higher. But we're starting to see that rhetoric pick up again. And so to the extent that he gets reelected, we think that will be a key focal point, and he will take a much harder line stance. And I think that will be something that the market is going to have to wrestle with for a while yet. We might see more tariffs. We might see more blocking of deals. I mean, the list could go on and on depending on what he decides to do. But that will inject a pretty significant amount of uncertainty. And I don't think it's really getting the attention that it deserves in the media, in the press, and really in the markets. That's a real significant headwind. And I would say from a portfolio positioning standpoint, it would be a big negative for emerging markets. We do have exposure to emerging markets. We continue to like emerging markets. We think it's one of the most, if not most attractive equity asset classes across the globe. They've handled COVID on a relatively better basis. I'm not talking China necessarily, just all of emerging markets has done a collectively better job. So they've entered it and exited first. They've seen a second wave. It's been very mild. They've been able to control it. Earnings growth has held up much better than every other part of the world. And we're seeing actually a really significant acceleration projected for earnings growth in 2021. So fell less far and a much more significant acceleration. And then the valuation story for emerging markets is really attractive. It's not quite half of what the S&P 500 is trading at, but a very significant discount. And so for all those reasons, we're actually very comfortable with emerging market positioning. But to the extent that that trade story started to rear its ugly head again, it could be a very significant headwind for our emerging market allocations. On the Democrat side, the biggie is taxes. At the end of the day, that is the thing that we're most concerned about with a Biden win and a Dem sweep in particular. We've done some back of the envelope calculations based on what he has proposed so far. Corporate rates going back to 28% from the 21% that they are at right now. We think that could knock off somewhere in the neighborhood of 11 or 12% of earnings growth in 2021. So when you think about the next 12 months earnings growth, we're only looking at about 1 or 2%. The lion's share of the pickup and acceleration in earnings growth is in the second half of 2021. It's kind of a Hail Mary into the end of the year. And so if he were to institute tax increases of this magnitude very early in the year, boy, that is a big headwind for earnings growth that is next to none, right, at 1 or 2%. And so as goes the path of earnings, so goes the markets. That's a mantra that we say over and over again. And so it's not our base case, again, because we think the COVID story will trump, pun intended, the tax hike story there. But it is something that we're watching very closely. A small offset to that could be Biden's softer stance around trade policy with China. He has kicked around the idea of rolling back China tariffs. And so if that were to occur, that might get us back another 5 or 6%. But it's still a significant net negative and a headwind to multinational earnings at a time where it's still very, very fragile in the backdrop. And then in terms of sectors, a couple of usual suspects. I don't know that there's anything here really revolutionary. The big one that's been talked about a lot is really big tech. Likely to be under scrutiny regardless of who wins. You know, the winners are always having the targets on their backs, right? And so at the end of the day, what is the regulatory backdrop going to look like for mega cap tech and Silicon Valley? We think it's probably more noise than news, but it's definitely something we are keeping our eye on. Healthcare, obviously in the midst of a pandemic, but in any election cycle, healthcare is always in the crosshairs. And so looking at rising costs, looking at drug price reforms, expansion of uninsured coverage, the list goes on. And so it's a headwind regardless of who wins the election in our view. And so continue to watch healthcare very, very closely. And then the energy story, another doozy. And it really depends on your point of view as to whether it's a winner or a loser. So very, very different kind of bifurcated outcomes depending on who wins. Clearly, regulations and restrictions have come down very significantly under the current administration. But Biden supports the Green New Deal. He supports ending oil and gas drilling on federal lands. He supports a recommitment to the Paris Agreement on climate change. And so for our ESG-oriented investors, our responsible investing clients, that is a really important and strong positive. And so it really kind of depends on your line of sight and your point of view as to how that may play out in a portfolio context. So again, positioning and exposures definitely matter there.